Hello everyone and welcome to Finance with JCL. I am doing a stock review for you today. Citigroup, ticker symbol C, with its primary listing on the New York Stock Exchange. I think firstly, let's start with what does Citigroup do? And you probably call them a diversified financial services holding company. They operate in many areas across the globe, not just in North America, but in most of the continents. And they've got kind of two key areas of their business. They've got the consumer banking side and then what you call the institutional customers. And on that consumer side, they have those traditional services, your bank accounts, your credit cards, and so on. On the institutional side, they've got more complex instruments, derivatives, research, corporate lending, investment banking advice, etc. They were founded 1812, so we're looking at a company that's over 200 years old and headquartered in New York. So that's a short background to the company. Now let's have a look at Morningstar.com and have a look at their 10-year financial history. The first thing I noticed is look at their revenue is it's very, very stable. You're looking at $70-something billion every year for the last 10 years. So there's an element of consistency there. And immediately in my head, I'm thinking, right, this clearly isn't going to be a growth company. It's probably more the Peter Lynch kind of stalwart type company, perhaps. And that's how I'm thinking about where it's going to fit in the portfolio if I buy it. Now we then have a look at the net income, and that it varies quite a bit. There's a bit of a blip in 2017. It's outstanding results, getting towards $20 billion in 2018 and 19. Bit of a dip in 2020, but not as bad as I thought they'd have. And then trading 12 months up to 16.5 billion. So they have been very good with their margins and their earnings per share. Thanks to the earnings per share here of $7.28 for the most recent period. That looks pretty decent. And now the dividend has gone from just 3 cents in the dollar, 444, 16, all the way up now to 204. So that's a really nice dividend record there. Excellent level of increase. And the payout ratio is 28%. So there is room for that to go further. Also really exciting is the number of shares. You're looking at 3 billion shares in 2012. You're now looking at 2.1 billion shares. A lot of share buyback. So I'm looking at this company thinking dividend shooting up, number of shares going down. This is the most stereotypical kind of stalwart type company, which is creating value through those methods. Now, the book value is very important for financial companies, perhaps more pertinent than the operating cash flows. We see the book value per share was $60 back in 2011, and it just creeps up. With that dip in 2018, it's crept up now to $88. So there's a company that's growing book value steadily over time. So to me, this looks like a strong company based on the numbers review anyway. I'll look at those net margins. In recent years, there's lots of instances of it being 20%. And the financial health of the company, debt to equity. Now that debt is a bit higher than I would like, 1.41. So ideally, you're below 1, and in the perfect world, you're below 0.5 in most cases. So it is higher than some of their peers in the sector. So I'm going to pull up some information from parts of Simply Wall Street. So first of all, on Simply Wall Street, you can see the PE ratio is around about 10. And it tends to be these steady financial firms do have lower PEs than some of the growth stocks. 10 is reasonably low. According to Simply Wall Street, it's a back pocket calculation. It's approximately fairly valued at the moment. The earnings aren't really going to do a great deal in the next few years. And in fact, potential negative forecast earnings growth from the analysts that they look at here. So I'll be interested to see what happens with that. Earnings per share is broadly going to be the same as it is now, potentially in 4 years' time. So not great. And we look at the financial health. So there's a little bit of an increase in the debt around about the virus time, which perhaps wasn't unexpected. Other than that, it's been pretty steady. Dividend 2.7%, which is all right. And what's quite interesting here is if you look at the leadership team, there's a new CEO that's not been in post for very long. Chief Financial Officer has only been there a couple of years. Even the Chief Accounting Officer, Controller, very new. So there's quite a lot of new faces and the Chief Compliance Officer in their leadership team. I don't know whether that's a good or a bad thing. I guess it's a bad thing that they don't understand the business as well as perhaps more experienced people, but it's a good thing if they're coming in with new ideas and they're better than the prior incumbents. I don't really know what the case is here, and so I have to do quite a lot of research probably to work that one out. And the ownership breakdown is what you'd expect with this kind of company, institutions and general public with not really any insider ownership. Right, Yahoo. So trailing PE 10, forward PE 9. You look at that, you're thinking, is that a 10% a year return with a PE of 10, give or take? And we know about the dividend being about 2.7%. So perhaps we could have a look at the analyst forecasts. This is quite interesting. So they're saying for the current year, earnings go up 85%. The next 5 years, they're actually saying positive 11% here. Well, that is slower than the past 5 years. There's quite a difference between the analysts that Yahoo have kind of compiled with the Simply Wall Street ones. And there's some analyst recommendations on the right here. I don't necessarily pay too much attention to those. But if everyone's saying sell and I'm saying buy, then I might think, what have I missed? But broadly speaking, it looks quite positive in that regard. So that's that. And then last but not least, we'll have a look at the price situation. So perhaps if we go back 5 years. So 5 years ago, we're looking at, that's 45, went down to 40, started increasing. 2018, they had a worse year. We saw the results, went all the way down to 50. Back up eventually to 80. The EV situation hit down below 40. 6 months ago, it's in the low 40s, and it's pretty much shot up since then. So if we look at the last year, you can see here now, nice line up there for the last 6 months. We're looking at a situation where it's kind of approaching the highs it had in the last 5 years. But quite interesting, if we look at the statistics here, it is priced below book value, and the PE looks reasonably attractive. So I think you could make a case, if you're looking for something steady to put in your portfolio, a company that's likely to be doing buybacks and have a 2 going on maybe for 3% dividend, and it's under book value. It's not a massive margin of safety there, particularly considering the debt. So I won't be buying this one. I think if it was, if I found this one when it was in the 40s, then I would have bought at that point. So I guess the situation is, I think for my portfolio, I've got probably too many holdings in my portfolio at the moment. Yeah, it's not a buy for me, but I can see why someone would want to buy it if they're looking to get stalwart into their portfolio. You've got a decent PE there, you've got a dividend, and they do have some nice margins. And then finally, if you want to buy this stock, you could do that in the UK through free trade. And through free trade, you can get a free share if you're not a customer, potentially up to the value of £200. If you're interested in that, have a look at the link below. And yeah, thanks for joining me. If you've got any feedback, please leave it in the comments below. And I very much look forward to seeing you on the next one.